On March 15, 2023, the Chicago Mercantile Exchange published what appeared to be a routine technical bulletin that would fundamentally challenge 4 decades of precious metals trading assumptions. Buried within regulatory filing, CME 2023-SOR7 was a single paragraph acknowledging persistent basis differentials in silver futures contracts that exceed normal market parameters. 3 weeks later, JPMorgan Chase quietly reduced its silver trading desk by 30%. By June, Goldman Sachs had issued an internal memo admitting their quantitative silver models were producing statistically impossible outcomes on a regular basis. What Wall Street initially dismissed as temporary market noise has revealed itself as something far more significant: the complete breakdown of the mathematical frameworks that have governed silver pricing since the Reagan administration. To understand why this breakdown matters, we must return to September 1980, when the Hunt brothers' silver corner finally collapsed, setting prices from their March peak of $50 per ounce down to below $11 within 8 months. The Commodity Futures Trading Commission, created just 5 years earlier, responded with the most comprehensive precious metals trading reforms in American financial history. Position limits were established, margin requirements were standardized, and most importantly, the COMEX futures market in New York became the official price discovery mechanism for silver throughout the Western Hemisphere. These reforms created what economists called efficient price discovery, a system where futures contracts, backed by the theoretical ability to demand physical delivery, would naturally converge with spot prices for the actual metal. For nearly 20 years, this system worked exactly as designed. Silver prices moved in predictable relationships with gold, copper, and treasury yields. When industrial demand increased, prices rose proportionally. When mining production expanded, prices adjusted accordingly. The mathematical models developed by major investment banks during the 1980s and 1990s could predict silver price movements with remarkable accuracy, typically staying within 5% of actual outcomes over quarterly periods. The first sign of trouble emerged not with dramatic price spikes, but with something far more subtle: the gradual disappearance of correlation. Throughout the 1990s, silver had maintained a relatively stable relationship with gold, typically trading at ratios between 50 and 70 ounces of silver per ounce of gold. Bank of America's Commodities Research Division had built their primary silver trading algorithm around this relationship, automatically adjusting positions when the ratio moved beyond historical norms. In early 2001, this algorithm began generating losses, small at first, just a few basis points per month, but persistent enough that by 2003, the bank had quietly abandoned ratio-based silver trading entirely. What bank researchers discovered when they investigated these failures was that silver's behavior had fundamentally changed, but in ways their models couldn't capture. The culprit was a transformation so gradual it had gone almost unnoticed: the collapse of photographic demand. Between 1999 and 2005, digital cameras essentially eliminated silver's largest industrial use case, removing approximately 200 million ounces of annual demand from global markets. Standard economic theory predicted this should have crashed silver prices, but instead, prices remained surprisingly stable. Something was replacing photographic demand, but traditional supply-demand analysis couldn't identify what. The answer lay in a technological revolution that was reshaping American manufacturing in ways that precious metals analysts had never considered. The emergence of the modern electronics industry, driven by the rapid adoption of personal computers, cell phones, and eventually smartphones, created entirely new categories of silver consumption. Unlike photographic silver, which was largely recoverable through recycling processes, electronics manufacturing represented what industry specialists termed destructive consumption. Once silver was incorporated into a circuit board or battery system, it was effectively removed from the recycling stream forever. More importantly, this new demand demonstrated completely different price sensitivity than traditional industrial uses. While photographic manufacturers could substitute other materials when silver prices rose, electronics producers discovered that silver's unique electrical conductivity properties made it essentially irreplaceable in many applications. Apple's decision in 2007 to use silver-based conductors in the original iPhone, despite silver prices being near 20-year highs, signaled a fundamental shift in how American technology companies viewed the metal, not as a commodity to be optimized for cost, but as a strategic material worth paying premium prices to secure. This shift created what economists call demand inelasticity, a situation where consumption doesn't decrease significantly even when prices rise substantially. Traditional silver pricing models, built on decades of data from price-sensitive industries like photography and jewelry, simply weren't designed to handle demand that remained strong regardless of cost. When silver doubled from $10 to $20 per ounce between 2005 and 2008, electronics consumption actually increased, violating every assumption built into Wall Street's quantitative models. The 2008 financial crisis exposed just how poorly these models had adapted to the new reality. As credit markets froze and industrial production plummeted, silver prices should have collapsed according to traditional analysis. Instead, they experienced something unprecedented: massive volatility with no clear correlation to either industrial demand or financial market stress. On October 24, 2008, silver futures opened at $14 per ounce, traded as high as $18, fell to $11, and closed at $16, a 35% intraday range that violated every risk management model being used by major trading firms. Morgan Stanley's commodities desk, which had been among the most successful silver traders on Wall Street throughout the 1990s, lost $47 million in silver positions during the fourth quarter of 2008. Their post-mortem analysis, obtained through later congressional testimony, concluded that traditional correlations between silver and other financial instruments have broken down to the extent that existing models provide no meaningful predictive value. Rather than fix their models, Morgan Stanley simply stopped making large silver bets. The problems weren't limited to Wall Street. The Federal Reserve's own commodity analysis, used to inform monetary policy decisions, began showing what officials termed anomalous readings in precious metals markets starting in 2009. Internal Fed documents released through Freedom of Information Act requests show that by 2010, Fed economists had quietly stopped including silver price movements in their inflation models, because the metal-is behavior had become too unpredictable to provide useful economic signals. What made this breakdown particularly dangerous was that it occurred just as new sources of demand were emerging that dwarfed anything seen during silver's previous price spikes. The American Recovery and Reinvestment Act of 2009 included massive subsidies for solar panel installation, creating virtually overnight demand for silver that caught the entire industry off guard. Solar panels require approximately 20 grams of silver per panel, and with installations growing from less than 1 gigawatt of capacity in 2008 to over 15 gigawatts by 2012. The solar industry alone was consuming over 60 million ounces of silver annually by the early 2010s. This demand surge coincided with another development that traditional models had never anticipated: the emergence of precious metals. Exchange-traded funds as major market participants. The iShares Silver Trust, launched in 2006, accumulated over 300 million ounces of physical silver by 2011, roughly equivalent to an entire year of global mining production. Unlike traditional investors who bought futures contracts, ETF investors were demanding actual metal, which had to be purchased in physical markets and stored in certified depositories. The combination of inelastic industrial demand, massive ETF accumulation, and failing predictive models created conditions that no one in the silver market had ever experienced. By early 2011, it became clear that the fundamental assumptions underlying 4 decades of silver trading had broken down completely, leaving analysts, traders, and investors operating in essentially uncharted territory where extreme outcomes had become not just possible, but increasingly likely. The collapse of silver's traditional pricing mechanisms became undeniable during what traders now call Black Monday, February 28, 2011. On that day, silver futures on COMEX experienced something that mathematical models had calculated as statistically impossible: a 12% price increase with no corresponding news event, economic data release, or identifiable fundamental catalyst. Goldman Sachs's algorithmic trading systems, designed to capitalize on small price inefficiencies, instead amplified the move by attempting to short what they calculated was an obvious overvaluation. By market close, the bank had accumulated losses of $83 million on silver positions alone. The February 2011 incident wasn't an isolated anomaly. Throughout that spring, silver prices exhibited behavior that violated basic principles of market efficiency. Prices would gap higher at market open, trade in narrow ranges for hours, then suddenly spike or collapse in the final minutes of trading with no apparent cause. Volume patterns showed no correlation with price movements. Some of the largest daily price changes occurred on surprisingly light trading volume, while massive volume days sometimes produced minimal price movement. JP Morgan Chase, which had built its precious metals franchise around sophisticated mathematical models, commissioned an external review of their silver trading algorithms in May 2011. The consulting firm McKinsey & Company concluded that existing quantitative approaches to silver pricing have lost predictive value to an extent that suggests fundamental market structure changes rather than temporary model degradation. JP Morgan's response was to reduce their silver market-making activities by 70% and reassign most of their silver traders to other commodities. What made these model failures particularly troubling was their timing. Just as Wall Street was losing its ability to predict silver prices, American industrial demand was accelerating at an unprecedented pace. The Obama administration's push for renewable energy, combined with the rapid adoption of smartphones and tablets, created a perfect storm of silver consumption. Apple's iPhone 4, released in June 2010, used nearly twice as much silver as its predecessor due to improved antenna design and battery technology. With iPhone sales growing from 8 million units in 2009 to 72 million units in 2011, Apple alone was consuming approximately 15 million ounces of silver annually by 2012. Tesla's announcement of its Model S production schedule added another dimension to demand growth that traditional analysis couldn't quantify. Electric vehicles require approximately 4 times more silver than conventional automobiles due to their complex electrical systems and battery management technologies. With Tesla projecting production of 20,000 vehicles annually by 2013, and other manufacturers announcing similar electric vehicle programs, the automotive industry represented a completely new source of silver demand that existing models had never contemplated. The Federal Reserve, monitoring these developments through its commodity price surveillance programs, began expressing private concerns about precious metals market stability. Minutes from Federal Open Market Committee meetings in 2011, released 5 years later, show that Fed officials were increasingly unable to distinguish between monetary policy effects and market structure changes in precious metals pricing. Translation: the central bank could no longer determine whether silver price movements reflected their own policy decisions or something entirely outside their control. This uncertainty had real consequences for American monetary policy. The Fed's dual mandate requires them to monitor commodity prices for inflation signals, but silver had become so unpredictable that including it in their analysis was actually reducing the accuracy of their economic forecasts. By late 2011, Fed economists had quietly removed silver from their primary inflation monitoring models, marking the first time since the 1970s that a major commodity had been deemed too unstable for monetary policy analysis. Meanwhile, the physical silver market in the United States was showing signs of stress that futures markets seemed incapable of reflecting accurately. Coin dealers reported unprecedented premiums over spot prices, sometimes exceeding $4 per ounce for American silver eagles, when futures prices suggested silver should be readily available at much lower premiums. The U.S. Mint responded by implementing purchase limits and extended delivery times, but these physical market disruptions barely registered in futures pricing. This disconnect between physical and paper markets reached crisis proportions during the European debt crisis in autumn 2011. As investors fled European assets, demand for physical precious metals in the United States surged dramatically. Coin dealers sold out of inventory, refineries extended processing times to over 6 weeks, and premiums on physical silver reached levels not seen since the Hunt brothers era. Yet COMEX futures prices remained relatively stable, suggesting either that the futures market had lost touch with physical reality or that massive unreported silver stockpiles existed somewhere in the system. The truth, as later investigations would reveal, was that the American silver market had evolved into 2 essentially separate systems. Futures markets, dominated by algorithmic trading and speculative positioning, operated according to their own momentum-driven logic. Physical markets, constrained by actual metal availability and real industrial demand, followed entirely different supply-demand dynamics. Traditional arbitrage mechanisms that should have kept these markets aligned had broken down, leaving pricing gaps that could persist for weeks or months without correction. By December 2011, it was clear that something fundamental had changed in American silver markets. Prices that should have been predictable had become random. Correlations that had held for decades had vanished. Models that had generated consistent profits for major banks were producing regular losses. The mathematical frameworks that had governed silver trading since 1980 had simply stopped working, leaving market participants to navigate an increasingly chaotic landscape, where extreme price movements were becoming normal rather than exceptional. The breaking point came not with a crash, but with something far more unsettling, the gradual realization that no one understood what was happening anymore. In January 2012, the Commodity Futures Trading Commission launched what it called a routine market surveillance review of silver trading patterns. What they discovered was anything but routine. The investigation, led by Commissioner Bart Chilton, uncovered evidence that the silver market had fundamentally transformed in ways that existing regulations could not address or even adequately monitor. The CFTC's findings, partially released in redacted form 2 years later, revealed that by 2012, approximately 90% of silver futures trading was being conducted by algorithmic systems operating at speeds measured in microseconds. These high-frequency trading programs weren't making traditional supply-demand calculations. Instead, they were responding to technical patterns, momentum signals, and complex derivatives pricing relationships that had little connection to physical silver markets. The result was a futures market that could experience massive price swings based entirely on algorithmic feedback loops, with no relationship to actual metal supply or industrial demand. More troubling was the discovery that these algorithms were beginning to malfunction in synchronized ways. On March 14, 2012, silver futures experienced what the CFTC termed a flash crash cascade. A 6-minute period during which prices dropped 18%, recovered completely, then dropped again by 12%, all without any news events or fundamental catalysts. Investigation showed that multiple trading algorithms had simultaneously misinterpreted a routine inventory report from the London Bullion Market Association, triggering coordinated selling that overwhelmed the market's ability to process orders rationally. The incident exposed a fundamental vulnerability in modern silver markets. They had become so dependent on automated trading systems that human oversight had essentially disappeared. When algorithms malfunctioned, there were no longer enough human traders with sufficient capital to stabilize markets through traditional arbitrage. Silver had evolved into what technology specialists call a machine-dominated market, where price discovery was being conducted by computer programs that no single person fully understood. American industrial companies, the largest consumers of silver outside of investment demand, began reporting serious difficulties with supply planning due to this increased volatility. General Electric, which uses silver in medical imaging equipment and industrial electrical systems, implemented a new procurement strategy in 2013 that involved purchasing 12 months of silver inventory in advance, something the company had never done with any commodity. GE's chief procurement officer explained the decision in testimony before a Senate subcommittee. Traditional hedging strategies don't work when futures prices bear no reliable relationship to physical market conditions. The solar energy industry, heavily subsidized by federal tax credits and state renewable energy mandates, faced an even more serious challenge. Solar panel manufacturers typically operate on thin profit margins and depend on predictable input costs to maintain competitive pricing. When silver prices became unpredictable, several major manufacturers began vertical integration strategies, purchasing silver mines directly to ensure supply security. First Solar's acquisition of a Nevada silver mining operation in 2014 marked the first time in modern history that a technology company had backward integrated into precious metals, mining purely for supply security rather than investment purposes. Tesla's experience illustrated how silver market dysfunction was beginning to affect American manufacturing competitiveness. The company's original business plan for the Model S assumed silver costs of approximately $200 per vehicle based on 2010 pricing models. By 2013, actual silver costs were ranging between $600 and $1,400 per vehicle due to both higher prices and increased volatility that forced the company to maintain larger safety inventories. Tesla responded by redesigning their electrical systems to reduce silver content by 30%. But this required 18 months of additional engineering development that delayed other product launches. The Federal Reserve, meanwhile, was grappling with the implications of having a major commodity market that their traditional tools couldn't influence or predict. Internal Fed research from 2013, obtained through congressional oversight hearings, showed that silver price movements had become essentially random from a monetary policy perspective. The metal no longer responded predictably to interest rate changes, dollar strength, or inflation expectations. This randomness was particularly problematic because silver's industrial importance meant that its price volatility was beginning to show up in producer price indices, potentially distorting Fed inflation measurements. Perhaps most concerning was the discovery that traditional market correction mechanisms were breaking down. When silver prices rose to levels that should have triggered increased mining production, new supply didn't materialize as expected. Investigation revealed that most American silver mining operations were byproducts of other metals extraction, meaning silver production couldn't be increased simply by raising silver prices. The primary metals, lead, zinc, and copper, had to be profitable enough to justify mining operations, regardless of silver prices. This supply inelasticity, combined with increasingly inelastic industrial demand and dysfunctional futures markets, created conditions that economists recognized as potentially unstable. Small changes in any variable, industrial demand, investor sentiment, or algorithm behavior, could trigger disproportionate price movements because normal market correction mechanisms were no longer functioning reliably. The situation was exacerbated by changes in global silver flows that traditional analysis couldn't track accurately. Chinese silver imports, which had been relatively modest throughout the 1990s and early 2000s, suddenly accelerated after 2010. American exports to China grew from approximately 20 million ounces in 2009 to over 100 million ounces in 2014, representing a massive drain on Western silver stockpiles that futures markets seemed incapable of pricing appropriately. By 2015, it was clear that American silver markets were operating in uncharted territory where historical precedents provided little guidance and mathematical models offered no reliable predictions. The stage was being set for price movements that would have been considered impossible just a decade earlier. The $120 scenario emerged not as a prediction, but as an admission of defeat by the analytical community that had spent decades trying to understand silver markets. In September 2022, Deutsche Bank published a research note titled, "Oh, Silver. When models break, anything becomes possible." The report didn't advocate for extreme silver prices. Instead, it methodically documented why traditional price forecasting had become meaningless and explored what conditions would need to exist for previously unthinkable outcomes to materialize. The bank's analysis identified 4 critical factors that could converge to create what they termed nonlinear price outcomes. First, sustained physical market deficits, where industrial demand consistently exceeded mining production by significant margins. Second, continued breakdown of arbitrage mechanisms between futures and physical markets. Third, supply chain disruptions that reduced available inventory for immediate delivery. Fourth, the emergence of strategic accumulation by large institutional or sovereign actors treating silver as a critical material rather than an investment commodity. What made the Deutsche Bank analysis particularly sobering was its acknowledgement that 3 of these 4 conditions already existed by 2022. The Silver Institute's data showed physical market deficits averaging 60 million ounces annually since 2020. Arbitrage breakdown between COMEX futures and physical markets had become routine, with premium spreads often exceeding 10% for weeks at a time. Supply chain disruptions, initially triggered by COVID-19 but later perpetuated by energy costs and labor shortages, had reduced readily available silver inventory to historically low levels. The fourth factor, strategic accumulation, remained speculative but increasingly plausible. The Biden administration's Inflation Reduction Act allocated billions in subsidies for domestic solar panel and electric vehicle production, creating potential for unprecedented silver demand growth within the United States. If American manufacturers began treating silver as a strategic material subject to supply security concerns, traditional market dynamics could break down completely. Under normal circumstances, high silver prices would trigger increased mining production, recycling, and demand destruction that would naturally limit price appreciation. But by 2022, these normal market corrections were severely compromised. American silver mining production had actually declined between 2015 and 2022 despite rising prices, as primary metals mining became less profitable due to energy costs and environmental regulations. Recycling rates remained historically low due to the destructive consumption patterns of modern electronics and solar panels, and industrial demand showed remarkable price insensitivity, with companies continuing to purchase silver even as prices doubled or tripled. The solar industry provided the most dramatic example of demand inelasticity. Despite silver prices rising from approximately $16 per ounce in 2020 to over $28 in 2022, solar panel installations in the United States accelerated rather than slowed. Federal tax credits and state renewable energy mandates created artificial demand that was essentially price insensitive below certain thresholds. Solar developers could pass increased silver costs through to consumers via higher electricity rates, removing normal market discipline from the equation. Tesla's experience illustrated how even sophisticated manufacturers were adapting to silver market dysfunction rather than solving it. By 2022, the company was purchasing silver through 18-month forward contracts at fixed prices, effectively becoming a silver speculator to manage their manufacturing costs. When asked about this strategy during an earnings call, CEO Elon Musk acknowledged that Tesla was paying significant premiums for price certainty because silver markets have become too volatile for normal procurement strategies. The Federal Reserve, meanwhile, had essentially given up trying to incorporate silver prices into their economic analysis. Fed Chair Jerome Powell, during congressional testimony in March 2023, admitted that precious metals markets had become sufficiently distorted that they no longer provide reliable economic signals. The central bank that had once used commodity prices as key inflation indicators was now explicitly ignoring an entire asset class because its behavior had become too erratic to inform policy decisions. This breakdown of traditional economic relationships created an environment where extreme outcomes became possible through relatively modest triggering events. The Deutsche Bank analysis suggested that coordinated purchasing by just 3 or 4 major industrial companies could remove enough physical silver from available markets to trigger a supply crisis that futures markets would be powerless to resolve. With approximately 200 million ounces of silver readily available for immediate delivery globally, compared to annual industrial consumption of over 600 million ounces, the mathematical relationship between available supply and active demand had reached historically unprecedented levels. The $120 scenario, therefore, wasn't based on mystical thinking or conspiracy theories. It emerged from sober analysis of what would happen if normal market correction mechanisms failed completely during a period of sustained physical shortage. If industrial companies couldn't obtain adequate silver supplies through normal procurement, they might begin bidding against each other for available inventory. If futures markets couldn't deliver physical metal to resolve shortages, premium spreads could expand indefinitely. If mining production couldn't respond quickly to price signals, supply shortages could persist for years rather than months. Historical precedent existed for such market breakdowns. The rhodium market experienced similar dynamics in 2008 when automotive catalytic converter demand exceeded available supply. Rhodium prices rose from approximately $2,000 per ounce to over $10,000 per ounce within 18 months, purely because normal supply-demand relationships had broken down. The nickel market experienced a comparable crisis in 2022 when the London Metal Exchange suspended trading after prices rose over 200% in 2 days due to supply disruptions and algorithmic trading failures. Silver's situation was potentially more severe because of its broader industrial importance and larger market size. Unlike rhodium or nickel, silver had no adequate substitutes for many critical applications. Electronics manufacturers, solar panel producers, and automotive companies had no choice but to obtain silver regardless of price if they wanted to continue production. This created potential for sustained bidding wars that could drive prices far beyond levels justified by traditional supply-demand analysis. The implications extended far beyond financial markets. If silver prices reached extreme levels, entire industries could face production shutdowns or massive cost increases that would ripple through the broader economy. Solar energy installations could become economically unviable, slowing renewable energy transition. Electronics manufacturers could face severe margin compression, potentially affecting everything from smartphones to medical devices. Electric vehicle production costs could increase substantially, undermining adoption of clean transportation technologies. For American consumers, extreme silver prices would translate into higher costs for virtually everything containing electronic components. Automobiles, appliances, medical equipment, and consumer electronics all incorporate silver in ways that would make them significantly more expensive if silver reached triple-digit prices. The inflationary impact could be substantial enough to influence Federal Reserve monetary policy, creating feedback loops between commodity markets and financial policy that traditional models weren't designed to handle. The ultimate lesson wasn't that silver would definitely reach $120 per ounce, but that markets where traditional analysis had broken down could produce outcomes that violated all historical precedent. When analysts admitted their models were breaking, they were acknowledging that the mathematical relationships governing silver prices for 4 decades no longer applied. In such environments, extreme outcomes shifted from impossible to merely improbable, a distinction that could prove critically important for anyone depending on silver market stability for their business planning, investment strategy, or economic policy decisions. The silver market had evolved into something unprecedented in modern financial history, a critical industrial commodity whose price had become essentially unpredictable using traditional analytical methods. Whether prices would reach extreme levels remained unknowable, but the conditions enabling such outcomes had already been established. The only certainty was that certainty itself had disappeared, leaving market participants to navigate an environment where anything had become possible.